Perry here for the Rant on October 4th. Well, I'll tell you people, the economy's getting pretty darn perplexing here, okay? We just had the biggest tightening since 1980-81, okay? Which caused the deepest recession since the Great Depression back then, okay? And it's had time to hit, although it will not most fully hit until early next year. But it's had plenty of time to start hitting, and we get the jobs report this morning, and it's up 250,000. New jobs and payrolls. I mean, it's 100,000 more than expected. And how could this be happening? Again, they not only raised rates 525 basis points, they also dropped the balance sheet. Now, the balance sheet had gotten very high, almost $9 trillion, but dropped that $1.9 trillion, taking that much money out of the economy while they're raising rates. We should be feeling this more. So that really means a couple of things. Either the stimulus that was so strong for so long that peaked in March of 2022 is kind of slow to recede, or there is another answer, which only we are aware of. The millennial generation, their spending wave actually starts to go up this year, 2024. Now, it's just the early stage of it, but that is a change in momentum from going down since 2007, okay, to heading back up. And of course, that's why we've had $27 trillion in stimulus, fiscal and monetary, to offset that big downturn, which in the past caused 1930 to 42, the biggest downturn in Great Depression in history, and also caused the long slowdown in growth from 68 to 82, which was inflationary because the baby boomers were entering the workforce, causing that. But those were, and we do tend to get these generational downturns. Well, what they've done is erased this one. This generational downturn should have come from 2008 through 2022-23. And of course, we've had the stock market go to massive new highs, okay? So this tightening should have been enough to put a halt to that, and the economy's pretty much brushing it off. Now, you'll know, people, in my newsletter, I keep saying, look, I can't really judge this until this, tightening fully hits by about the end of January next year, but we're only like 4 months or so from that. So this is really getting interesting. Now, I still think it still looks like stocks may be peaking here for the S&P 500. And real quick, let me go through the long list of divergences. I mean, again, this is the biggest sign that this is not just an ordinary strong bull run in top that's going to go down and then we go to new highs, the next year to follow or something like this. Here's the long run of key financial indexes and stock markets that have peaked and never made a new high since. First, in July of 2007, the high yield bond index. Now, they're the most sensitive to slowdowns in the economy, failing debts and stuff like that. That peaked in July 2007, never to get anywhere near that high again. Then the Shanghai Composite in China, the economy that has the worst, the major economy that has the worst demographics, the only emerging country with demographics heading down. The stock market picked up on that back in September 2007. Then TLT in 2020, July 2020, the Treasury bonds, okay, they're sensitive, okay. That peaked in July 2020. And then the corporate bond market in September 2020. And then the biotech index in stocks peaked in September 2021, and again, nowhere near the highs, followed by the Russell 2000, which is the biggest divergence, peaked in November 2021 and still 10% off of its highs after a very strong rally here. That's still saying major top going on, major divergence still in place. The crypto, Bitcoin, peaked first, and it has been leading the stock markets, as I keep telling newsletter subscribers. That is our leading indicator, more short term. That peaked in March and is nowhere near its new highs. In fact, it is falling again, even though it hasn't made new lows on this fall yet. Once it breaks 54,000, that's going to be a real sign we're in trouble. But it's down around 60,000 here recently. after peaking at 73,750. So that peaked in March of this year. The FTSE in the English stock index in Europe peaked in May of 2024, and then the NASDAQ here in the QQQ, the NASDAQ 100, and the Nikkei in Japan peaked in July of this year, 2024, leaving only the DAX, the strongest leading index in Europe, to make a final new high and go down, and the S&P 500 here, and those could have peaked in September, okay? Just here currently, and they might make slight new highs as well. We'll see on that. But this progression says this is a major top forming. Now, what is confounding is that it's taken so long. We're talking about 3 years to make this top again. So again, that confirms it's got to be a big crash when it happens, and we're not going to have a soft landing or a moderate crash, okay? But it is getting frustrating that no matter what happens, and with this massive tightening, that the economy, not just the stock market, but the economy is not really feeling it yet. So we just have to be on clear watch here. In the coming months, it still makes sense to be out of stocks here. It still makes sense to be in either cash or in the safest bonds, the TLT, okay, or Zeros, which is a little more leveraged than that with the long-term treasuries, or TMF if you want to take a little money to hedge everything and keep a lot of cash available. Those have been finally edging up since April, okay? I mean, I really expected that TLT would bottom well before that at 92, but it went down to 87 just to test everybody, but it has been going up since. So the basic trends, economy or stocks looking toppy, I mean, again, if only the DAX and the S&P 500 make a new high, that's a huge divergence, and says this is looking like a top. We just need the economy to show some weakness, and we need some follow through on the downside. So again, out of stocks, long treasury bonds, or you're fine to just be in cash and T-bills here earning, near 4%, and wait to see if we start to get a little more weakened economy, and then you can get into the treasury bonds, TLT, Zeros, TMF, because people keep writing in saying, well, it's not going up that much, or it's taking long. Well, these explode in the downturn, okay? That's the point. They are your safe haven divergence, where everybody else like Peter Schiff and the gold bugs are saying gold's going to be that. I'm telling you, gold is not going to be that. And I've got a chart I'm putting out soon showing that gold looks like it's at a major long-term top. If it just goes, a major long-term trend line top, just a little bit above where it is, and then it should fall to at least 1100-ish or so, its last major low. So gold is not it. Out of stocks is still a good place to be. Treasury bonds, TLT, etc. If you don't want to be in cash and neutral. And yes, the Fed's trying to get back to neutral in rates, but you got to remember that is still tight, okay? So they've gone from 525 to 475. Now they're probably going to go down a little slower with this good run, but if they keep going out, they're just trying to get back down to about 3.25, and that's just neutral. They're still net tight. So this economy's got to give sooner or later, and we'll just be safe until that becomes more clear.